How much did you pay for your last coffee? I'm guessing it was probably more than what you paid 12 months ago. That's because inflation is at record high levels around the world, and in part thanks to Russia's invasion of Ukraine, it's set to get even worse, which means that everything from food to petrol is going to get even more expensive, and the purchasing power of your cash is diminishing fast. In fact, if inflation rates stayed the same over the next 10 years, your money would be worth half what it is today. Scary stuff. So if cash is going backwards, what should you be doing with your money? In February 2022, US inflation hit 7.5%. That's the highest it's been in 40 years. That means that most US citizens have not seen inflation this high in their adult lifetimes. Some are learning for the first time what inflation really is. And that means they're needing to learn new money strategies. At the same time, central banks are looking to raise interest rates. When interest rates go up, the cost to borrow also increases, and inflation should start to cool. The problem is, we're not sure how high rates will go and whether it will bring inflation down to normal levels. It's no wonder all that uncertainty is getting people worried. And when people start to worry, they start to make irrational decisions with their money. Believe me, I get it. The good news is that we've been here before, so we know what strategies have worked in the past. So I thought it would be a good idea to run through popular strategies for dealing with a high inflation environment. By the end of this video, you'll understand how inflation can impact your money and what strategies you can take to beat it. Before I go on to the strategies, a few points on why it's so hard to beat inflation and why this has been a nightmare for people struggling to save their money. And if you like this video so far, please do me a favor and hit the like and subscribe button so I can keep making more videos just like this. So beating inflation is just about making sure the purchasing power of your money isn't falling behind the growing cost of things, which is the rate of inflation. And a few years ago, you could have done this by simply putting your money into a high interest savings account in the bank. And that's because interest rates offered by the banks were higher than the rate of inflation. For example, back in 2012, major banks were offering term deposit rates of around 4%. At the time, the inflation rate then was around 2% in developed economies, so keeping your cash in a term deposit still beat inflation by 2% annually. But with interest rates continuing to drop over the last decade, that hasn't really been an option since around 2019. For instance, I've got friends who have worked really hard and have their entire life savings sitting in term deposits in the bank. And how amazing is that? The problem is, when they finally do tap into their savings won't afford them the same amount that it does today. By the time people, including retirees or people saving for their retirement, realize what has happened, it may be too late. And this is the dark side of inflation. Okay, strategy number 1, shift away from cash. Outside of having 3 to 6 months of cash as an emergency buffer, a good strategy is to shift your cash into other types of assets. In other words, investing your money. So that might include into stocks, ETFs, bonds, property, gold, and these days even cryptocurrencies. These types of assets can be riskier than cash because the markets that they're in can be volatile, but they have a better chance of beating inflation in the long run, especially if inflation rates stay above interest rates for some time. In a study by Wells Fargo, the top performing assets during periods of inflation were oil, followed by emerging market stocks, gold, and cyclical stocks. Strategy 2 is to invest in hard assets. When inflation is high, hard assets tend to do better. So hard assets are physical things like property, commodities like oil, and metals like gold and silver. These assets tend to see prices rise with inflation, just as your morning coffee does or your groceries. Depending on your circumstances, some of these things like barrels of oil or a house might be out of reach. But there are other ways to invest in hard assets. For instance, you can invest in property stocks like REITs or thematic ETFs like oil and gold ETFs. You probably noticed the housing and stock market hitting record levels over the last couple of years. High inflation with low rates can be an especially good combination for property investors. If you're able to get a fixed rate on your mortgage, you'll be paying lenders back with money worth less than when it was originally borrowed. There's a lot of different ways to invest in various types of hard assets, so for more info, I've left a few links in the description on how you can invest in property, gold, and commodities. I hope you're enjoying the video so far. Coming up next are 3 strategies used by some of the world's top investors to beat inflation, Plus, I'll share what I'll be doing with my money, so stick around for that. Next up, invest in profitable companies. Many big-name investors, including Warren Buffett and Cathie Woods, believe stocks are still one of the best places to keep your money, regardless of inflation or rate hikes. But the types of companies you invest in can make a world of difference. If we're to take the lead from Buffett, a key inflation strategy is to buy stocks in companies that are making a profit, as opposed to high-growth, high-debt companies. That's because cash balances are healthier, and so companies are in a better position to change their business strategy to better suit the changing climate. And you might think that this is obvious, but a lot of major companies don't actually make any profit, including Uber, Snap, Pinterest, and Airbnb. The caveat to buying up stocks is that they might fall as interest rates rise, at least in the short term. So having too much of your wealth tied up in stocks may also not be a good idea, especially if you need that money over the next couple of years. And Buffett himself may actually be preparing for this. The latest filing from Berkshire Hathaway shows he has been selling more stocks than he is buying. The next strategy is invest in inflation-hedged bonds. So bonds are a common investment when economic risks are higher. That's because they're a type of fixed rate asset, so you know exactly what you're going to get at the end. The downside of investing in bonds is that if inflation runs high and interest rates rise, you could be stuck in an underperforming asset, similar to having your money locked into a term deposit. But there is another option. Ray Dalio believes inflation-hedged bonds, rather than regular bonds, are a good strategy for the next couple of years. These are bonds, or government securities, that mirror the rise and fall of inflation. So when inflation goes up, so does the amount of interest paid out to you. TIPS bonds pay interest twice a year at a fixed rate, and they're issued at 5, 10, and 30-year maturities. At maturity, investors are paid the adjusted principal or original principal, whichever is greater. And you can only purchase up to $10,000 in bonds per calendar year, and you cannot cash the money out in the first year. Also, it's worth noting that the bond products available to you will be different in each market. So the bond products available in the US, for instance, will be totally different to what is available in Australia. Next, stay diversified. So while many of us try to outwit the market, the truth of it is we can't predict which direction the economy will swing in the next few years. The most important strategy above all is to make sure your portfolio is diversified across multiple asset classes. Yes, it's an old principle, but it bears repeating, especially during times of high inflation and volatility. In a recent note from Ray Dalio warning investors about the current economic crisis, he reiterated this as being the #1 strategy to follow. So that means ensuring you have enough cash for emergencies, and then the remainder invested across stocks, property, bonds, gold, and even crypto, depending on how much risk you can take on. And again, of course, all of that totally depends on your circumstances. Okay, so what am I doing? Well, in the last 3 months, I'll admit to not doing a lot. As I'm a long-term investor, I don't do a lot of trading day to day. I have invested in property in the last 12 months, which has helped a lot in keeping up with inflation, and I've started investing more in crypto with money that I know I can lose. As for stocks, well, I was burned during the 2020 market crash when I sold a lot of stocks, so I'm wary of doing that again when the economy is going through this pretty uncertain time. At the same time, I'm also not buying a lot of individual stocks because there are indicators the market could be in for more of a correction. Instead, I'll go on a buying spree when that happens, and I've got my shopping list ready for that. That being said, I am continuing to invest slowly into the stock market by dollar cost averaging. And the reason I'm dollar cost averaging, which means investing small amounts of money regularly into an investment like stocks or ETFs, is because I'm taking a longer view of inflation rather than a short-term view. And that's because we don't really know where inflation will be in the next 12 to 24 months. There are so many moving parts. Interest rates may or may not go up. We've now got Russia invading Ukraine, which is impacting a whole lot of different markets, including the energy market. Depending on what happens in the coming months, we can expect the stock market to remain pretty volatile. And by dollar cost averaging into stocks and ETFs, you're minimizing the impact that volatility has. So you're not trying to time the market, you're not trying to guess at what the government is going to do next month, you're not trying to guess at what major investors that impact the stock market are going to do. So that's my plan anyway for the next few months. What about you? What are you doing to beat inflation, if anything at all? I'd love to hear your thoughts in the comment section below. Thanks for watching.